Capital markets, the engines that drive economies around the world, consist of two major divisions: debt markets and equity markets. These components differ fundamentally in their structure, risk offerings, potential returns, and have different consequences based on their operations. Understanding these differences helps investors make more informed decisions, thereby strengthening the financial health of individuals and nations alike. Historically, debt markets, also known as bond or fixed income markets, have been integral to the fiscal mechanism of civilizations. They trace their origins back to ancient civilizations like those of Mesopotamia and Rome, where they were used for lending grains or precious metals. During the 12th century Renaissance, debt markets began to resemble their modern counterparts as governments and municipalities in Europe started issuing bonds to finance their obligations. Equity markets, on the other hand, have a rich history paralleling the establishment and expansion of the world's earliest companies. The 17th century Dutch East India Company was the first company to issue shares, leading to the formation of the Amsterdam Stock Exchange. This practice burgeoned across the globe, paving the way for today's stock exchanges. At their most fundamental, debt markets are loan markets. Investors lend funds to governments, municipalities, or corporations, becoming creditors with an expectation of regular interest and a return of the principal amount at the end of a predetermined period. The significance of debt markets primarily lies in their ability to fund large-scale projects, stimulate the economy, service public debts, and manage cash flow. They're generally perceived as safe investments due to the legal obligation of borrowers to repay, though lack of payment can result in default. Conversely, equity markets deal with shares of company ownership. When investors purchase shares, they become part owners of a company, granting them residual claims to the company's profits and assets. Equity markets are essential because they create a platform for companies to raise capital without increasing debt. However, equity investments are considered riskier than debt instruments. Shareholders are residual claimants, meaning they're only entitled to what remains after a company satisfies all its other financial obligations, a unique facet of equity markets. Besides, equity investments don't guarantee a fixed return, as company profits fluctuate based on market factors and managerial efficiency. A notable distinction is the reward system inherent in both markets. Whereas the debt market rewards lenders with predetermined interest rates, equity markets reward shareholders with dividends tied to company profits and potentially higher prices from the sale of their shares. These differences underline the risk-reward trade-off evident in both markets. The safety of bonds comes with lesser overall returns, while the higher potential returns of stocks come with increased risk. At a macroeconomic level, both markets have critical implications that can ripple across an entire economy. An overly dominant debt market can lead to excessive borrowing, potentially triggering debt crises like the one witnessed in the Eurozone. Concurrently, an overheated equity market can lead to asset bubbles, like the tech bubble of the early 2000s, possibly crashing entire markets. It is important, therefore, to have regulatory frameworks in place that promote a balanced blend of debt and equity market activities. This balance ensures that economies can meet their immediate financial obligations through debt, while equity offers the potential for long-term growth and development. In sum, though both debt and equity markets share the fundamental objective of capital allocation, they diverge significantly in their structure, investment products, risks, and rewards. A robust understanding of these differences is aptly beneficial to both individual investors and policymakers in shaping a resilient and prosperous financial landscape.